From Deloitte Tax and Legal Japan, welcome to the Japan Perspective. This is a podcast where we speak to specialists from across Deloitte to discuss the latest business issues impacting foreign multinational companies in Japan. I'm your host, Joanna Hazel. Today's episode, we are joined by Ken Leong, who is a partner in our tax team here with Deloitte in Tokyo. And if you joined our debriefs last month, you may have heard him talking about factor-based enterprise tax, which is what our episode is on today. So thank you very much for joining us, Ken. Can you give us an overview of what factor-based enterprise tax is for our listeners before we dive right in?
Yes, and hi to our listeners and to Joanna. So basically, corporate tax comprises three components. So we have a national corporate tax, we have an inhabitants tax, and an enterprise tax. So in principle, enterprise tax is calculated based on taxable income only. But for a company with paid-in capital exceeding 100 million Japanese yen as of its fiscal year end, enterprise tax is calculated under the factor-based system. So under the system, enterprise tax is calculated based on taxable income, a value-added component, and a capital base, which is generally the total of paid-in capital and capital surplus. So the intention of the factor-based system is to ensure that large companies that are incurring tax losses are still liable to pay some tax by reference to the amount of their capital or key expenditures such as salaries, rent, and interest. As the former factor-based system was applicable only to a company with paid-in capital exceeding 100 million yen, this created loopholes for a company to avoid the application of the factor-based system. For example, under the previous law, a company could avoid the application of the factor-based system by undertaking a capital reduction and transferring paid-in capital surplus to reduce its paid-in capital to 100 million yen or less.
Okay, thanks for that overview, Ken. So I'm assuming based on what you said, the new tax reform is meant to hopefully remove some of these loopholes.
Yes, it does. So the 2024 tax reform addressed these loopholes by expanding the scope of companies subject to the factor-based system, even where they have paid-in capital of 100 million yen or less. And this was achieved by introducing two new rules relating to companies which undertake a capital reduction, and the second rule to certain 100% owned subsidiaries. So let's look at the capital reduction rule first. This rule is effective to fiscal years commencing on or after 1 April 2025 or 1 January 2026 for calendar year end companies. So it employs a look-back mechanism. So if a company is paid in capital at 31 December 2026 is 100 million yen or less, we look at whether it was subject to the factor-based system in the previous year. And if the answer to that is yes, the company will continue to be subject to the factor-based system if the total of its paid-in capital and capital surplus exceeds 1 billion Japanese yen.
Okay, so you mentioned that this capital reduction rule is not going to be effective until fiscal year 2026 for those companies that have a calendar year end. What is something that our listeners should consider now in 2024?
Okay, so the obvious strategy is for a company to reduce paid-in capital now, but we need to consider transitional measures which will apply to the capital reduction rule. So under the transitional rule, the promulgation date of the new law is expected to be this month, March 2024. So the relevant test year we're looking at is FY 2023. So using the example of a company with a December 31 year end, let's assume it's subject to the factor-based system during FY 2023. So it reduces its paid-in capital during FY 2024 to 100 million yen or less. So it's not subject to the factor-based system in FY 24 or FY 25. When the new law becomes effective in FY 26, strictly speaking, the company is not subject to the factor-based system in FY 2025. But as the relevant test year under the transition rule should be FY 2023, the company will continue to be subject to the factor-based system.
Okay, thanks for that, Ken. I know you talked about that this rule also applies to certain 100% subsidiaries as well, and I'm sure that affects some of our listeners here. Can you talk a little bit about how the rules apply in that circumstance?
Okay, so under the previous law, if a subsidiary had paid in capital of 100 million yen or less, it was not subject to the factor-based system. Under the new law, a subsidiary will be subject to the factor-based system if its total paid-in capital and capital surplus exceeds 200 million yen, and the subsidiary is 100% owned by a company whose total paid-in capital and capital surplus exceeds 5 billion Japanese yen. So this rule will be effective to fiscal years commencing on or after 1 April 2026 or 1 January 2017 for calendar year-end taxpayers.
I see. So, as I previously mentioned, I think a lot of our listeners are from multinational groups with wholly owned Japanese subsidiaries and are probably curious about how this affects them. So, anything that they should keep in mind based on your knowledge?
Well, there has been some uncertainty and some question as to whether the new law will apply to Japanese subsidiaries of foreign parented groups. Now, this uncertainty seems to stem from a note within the proposals that indicated that the new rule will not apply to a subsidiary whose parent company is not subject to the factor-based system. So if we look at the typical foreign parented company which owns a Japanese subsidiary, that foreign company would not be subject to the factor-based system unless it has a permanent establishment in Japan. So taking a more literal interpretation, it can be concluded that the proposal would not apply to a Japanese subsidiary of a foreign parented company. But the draft tax laws have been issued now, and they do not specifically carve out Japanese subsidiaries of foreign parent companies. So the enforcement orders for the new laws, which are expected to be issued later this month or later in March, do not include specific carve-out provisions. We think Japanese subsidiaries of large foreign parent companies should be subject to the new law.
So, if we consider that thinking, it would seem that there is no intention to include Japanese subsidiaries of foreign parented groups.
That's right. Logically, it makes sense that Japanese subsidiaries of large foreign companies should be included, as every Japanese company should be taxed in the same manner, irrespective of who its parent company is.
So, you mentioned that's the case when you're thinking about it logically, but practically speaking, what does this actually mean for companies?
Well, there are four things to be aware of. First, the subsidiary will have a reduced income levy, but subject to a new capital levy and a value-added levy. So whether in aggregate the company would have a larger or smaller tax liability will depend upon the company's specific attributes. So highly profitable companies may see a decrease in enterprise tax, while companies with a significant amount of capital may see an increase. Second, the overall effective tax rate of the company will drop, typically from about 34% to about 30%. And this would impact the company's deferred tax calculations.
Okay, sorry to cut in here. I know you mentioned there were four things to keep in mind, and we just covered two. But before we move on to the third one, I'm curious how the calculations for those deferred tax calculation will be affected, and if anything in particular that companies should be thinking about.
So generally, a company would calculate their deferred tax asset or liability amount based on the tax rate at which the items giving rise to the deferred tax will reverse in the future. So for example, an NOL which will give rise to a deferred tax asset, but the amount of the deferred tax asset will depend upon the effective rate at the time the NOL is expected to be utilized. So for a calendar year taxpayer that will be subject to the new law, any portion of the NOL that is expected to be utilized in 2027 and after will need to be calculated at the lower effective rate as a result of being subject to the factor-based system.
Thanks for that. You mentioned that there were four things to keep in mind in terms of the impact of these proposals, and we just covered two. So let's move on to the third and fourth points.
Okay, so the third point is that the value-added levy and the capital levy are generally above the line taxes, and this may impact businesses which use income before tax as a KPI. And finally, the value-added levy and capital levy are typically not creditable taxes under other jurisdictions' tax laws. So where these companies have used Japanese taxes to offset their home country tax liabilities, the amount available as a tax credit may likely to be reduced.
So from my understanding, while this proposal is not expected to take effect until fiscal years commencing on or after April 1st of 2026, it sounds like companies may want to simulate what the potential tax impact might be if they are subject to this proposal. And if the result is that the company is subject to more enterprise tax, is there anything in line with business objectives that company can try to do and mitigate?
Maybe 2 points to consider. First, the new law comes with some transitional rules which will allow companies which have a greater tax liability under the factor-based regime to reduce their liability in excess of what they would have paid under the normal enterprise tax regime by 2/3 in the first year and 1/3 in the second year. And second, if a company has a significant capital which is causing the increase in tax liability, and that capital is not needed in the business, it may be able to make a distribution out of its capital surplus. Of course, there are tax and legal and treasury implications that would need to be considered.
Thanks, Ken. I think that was a lot of really helpful information for our listeners here on this new regime. Before we go, are there any last pieces of information or points to note to leave our listeners with?
Yes, I should add that any distribution out of capital surplus after the date of promulgation of the new rules, which is expected to be March, will be clawed back for the purposes of determining whether a Japanese subsidiary is subject to the new law. In other words, making a distribution out of capital surplus may not get a company out of the factor-based system, but it could help to mitigate the impact.
Well, great, Ken. Thank you so much for that. I hope that this was very helpful for our listeners and they now have a better idea on how factor-based enterprise tax and the reforms might affect them. So for those of you who would like to know more, please feel free to reach out to either Ken or I on LinkedIn. And we also have a newsletter of 2024 tax reform proposals published on our website. Thank you again for listening, and thank you again for joining us today, Ken.